Let's talk commodities and strength in the greenback. Larry Shover from Efficient Capital Management and author of Trading Options in Turbulent Markets for you now live at the CME Group in Chicago. Larry, the dollar. For once, you know, it's bounced back up. But is this a short-lived bounce or has it got some more legs in it?
I like to say it's a dead cat bounce here. Everybody in the United States has gotten so excited with the passage of the Bush tax extension of 2001, 2003. You see what's happened in our Treasury market where the bonds have absolutely collapsed since Monday, and the dollar has rallied even against the Australian dollar of all things. There seems to be a flight from commodities, a flight into riskless assets, into risk. I think that there's just too many headwinds in the economy right now that I do believe this is a dead cat bounce. I'm thinking of the sovereign debt crisis, the Chinese forcing to deal with their inflation issues, the squabbling in Congress, and all the other things with the housing market. I just can't see this continuing very longer. It might be a very good time to get back in and sell the dollar and also get in there and buy treasuries.
It hasn't stopped ETF's new securities, copper, nickel and tin exchange-traded commodities entity buying up big time. They're going to be launching on Friday. How bullish has that been for price?
That's really a scary question. I just read something about that not too long ago about another ETF buying up a lot of copper reserves. Yeah. And the minute ETFs, which fundamentally are equity-related products, start cornering markets or even give the notion that that's what they're going to do, it kind of strays away from the intention of what an ETF is. So it's going to be very interesting to see how it all plays out and if the regulators are really watching.
Are you saying there's going to be, though, that inevitable realization that we've got a supply squeeze going on? The demand from the ETFs has been rampant, but when it comes to delivery of something like copper, if you've got nothing in the storehouse, what are clients going to say?
No, exactly, and that's just a problem with, it's always going to be the small guy that gets hurt at the end of the day. I mean, a report just came out this morning, U.S. time, with Indonesia cutting their production, and at the same time, Russian auto sales were at an all-time high, both big users of copper, and it's going to come to a point in time where if you seek delivery, you're not able to get it. So we're going to see price escalation unparalleled, especially in copper. It's amazing to see today the copper was up again. It's not up to its 2.5-year high as it was a few days ago, but when you look at gold and silver in comparison, with gold being down more than $26 an ounce, copper has shown a lot of strength. It's a little eerie, to tell you the truth.
Larry, Al Fullerton here, Allianz Markets, sticking with copper there. You know, certainly this is on the back of it, and it's been quite well flagged that there are rumors of the 2011 supply constraints, and couple that with this ongoing Chinese growth thematic, it's really keeping copper well supported at these record highs.
Yeah, I still think we're going to see copper extend its gains only for the things that you just mentioned, and if not more. I mean, you can't ration demand. That's the problem. You might be able to ration the supply, but the demand for copper, with the slight expansion we're going to see in the U.S. and the bigger expansion we'll see in some of the other nations, copper is going to be much higher than it is today.
Can we talk Germany as well? We got some good numbers out of them when it comes to industrial production. Again, you know, we can get sideswiped by the peripheral economies. I know the net's closing in on some of the more developed ones as well, but still, Germany holding steady. Right. There's only going to be a net positive, is it not, for the suite of base metals?
Absolutely. Germany really has its act together in terms of fiscal responsibility. My fear is, and I try to remain positive, but when you see these other nations, the GDPs that they have in comparison to Germany is quite small. But GDP at the end of the day is probably a poor way of looking at risk management. What I'm nervous is if Germany would have to take a banking haircut on some of these other nations, it could destroy or severely cripple the German banking society, and that's the outlier that people aren't talking about.
Yeah. Are people talking about crude above 90 a barrel crippling the US consumer? It's paired those gains. Thank goodness for a strong dollar on that one. But where do you see it above 90 when it comes to recovery US style?
Well, you know, it's funny. The best economists are forecasting a 2.5% GDP for next year, which everybody is high-fiving one another at 2.5 GDP. And that's pretty paltry, to tell you the truth. With that said, if that's true, a 2.5% GDP, bare bones minimum, crude oil will not cripple the economy. It'll limit some things for sure in industrial production, so on and so forth. But we in America have gotten so used to this oil price that it's not going to have that big of an effect on oil. And one thing that came out this morning that was quite intriguing is oil reserves were actually higher, whereas gasoline inventories were lower. So you'd see the difference in the gasoline versus the oil spreads this morning.
And Larry, Al Fullerton here again. Just sticking with oil there. What are the real sort of near-term catalysts? I know that a lot of analysts are quite bullish on oil. Certainly Q1 next year, we may see it up towards $100 level. Do you agree with these analysts? And what do you see as certainly the nearer-term catalyst for oil to get through that $100 mark?
If we go back to 2.5% growth, if we keep our unemployment rate below 10%, if we're adding jobs, $100 barrel is definitely in question, especially when you look at all the other commodities, looking at the metals, looking at the agriculturals, the wheat, soybeans, corn, everything's up. Oil will easily rally to $100 a barrel. That's not a question at all, given the scenario that all the other commodities continue to rally as well.
You've talked about that rise in wheat. It's been well documented in Australia, the tragedy of floods in some of that heartland farming area. Is that already translating into that squeeze, the sense of a squeeze on supply, and therefore who's going to meet that shortfall?
Yeah, it seems, but one of the things that people are talking about here, not as much about wheat, more about corn, and the corn price seems to be going up with reckless abandon. A lot of that is due to the sharp spike in ethanol prices, which, you know, is taking a lot of the corn supply. To answer about wheat, it just kind of rallies in tandem with everything else, and wheat is up again, corn's up again, soybeans are up again. What gives? Commodities overall are a little bit mixed today, with cattle being flat, but yeah, the wheat is definitely an issue, and I still think, as I've said about a month ago, that wheat will continue to rally.
Just a brief and final thought. You did flag jobs as being so critical to the whole putting this puzzle of your economy back together again. A print overnight is expected. It's a weekly one. Will markets just cast it aside, or will they be more looking at that 4-week moving average and getting some optimism? They'll need it after that shocker of a number on Friday last week.
And that was a shocker, no doubt about it, 9.8%. I think we're really continuing to look at the moving average to seeing how many jobs are actually being created. And the market will price in the fact that this tax cut that was passed a few days ago isn't going to be reflected in the numbers for quite a while, but it definitely is a shot in the arm. It's something that our economy is desperately needed, because as you know, if my boss has to pay higher taxes, and he has to pay more of his income to property or income taxes, whatever the case, I'm not going to do well, and they're not going to hire new employees. I mean, it's pretty common sense. So with that in mind, we need to create more jobs, and hopefully that unemployment rate can get down below 9% this time next year.
Larry, we do value it. We're watching those numbers with interest for now. Thanks so much.